Been another wild week in the oil markets. A $9 range in WTI, triple digit tariffs between China and US. What does it all mean? Let's get into it this week in oil. Hey, I'm Aaron from the Oil Balance. I'm here to elevate your understanding of the oil markets. Please like and subscribe to this channel and visit our website for more information. That's theoilbalance.com. And as always, I'll be happy to send you a copy of this presentation if you're interested. So like we did last week, we're going to start off with the price charts again this week because that really seems to be the crazy thing going on in the market right now. So let's take a look. Here's a long-term weekly WTI chart. Again, I like to look at the weeklies, and especially in these sorts of situations where it just gives you sort of more time and more context to look at things. So we had, like I mentioned, a big range in the front end of WTI. This week, nearly $9. Last week, we had nearly $12 range in the front end of WTI. The thing is, though, this week we got all the way down to $55 on the low end of things. And then we were able to bounce back with all those headlines flying around, especially with the news, the 90-day pause in overall tariffs, except for China. We'll get more into that here in a minute. But at any rate, $55 takes us all the way back here to early March of 2021. So it's been quite a while before we've seen the lows where we stopped this week. And again, I'll remind you that for shale production, West Texas or North Dakota, Colorado, Wyoming, you're probably looking at, you need the producers probably need a forward curve of at least $60, $65 just to keep investing money into their ventures. If we were to stay in the $50 range, like around $55 for a period of time, right? We've been down here for a week and we shouldn't make too much out of it just yet. But what I'm saying is if we stay, 3, 4, 5, 6 weeks down at these sorts of levels, call it between $55 and $60, a lot of these producers are going to lose interest in drilling new holes. So that's kind of what we're up against. If you look at more of the deep water Gulf of Mexico or Gulf of America type production that's going on, that's a lot more intensive. It takes a lot more money to drill those wells and to get it connected back. The lead time, like I've mentioned before, is much longer. So for deep water stuff, you're talking 2 to 3 years from FID to actually getting oil into a pipeline system and bringing it back on shore. For shale, it's a little bit less, probably 3 to 6 months, depending where you are and what your connectivity is. The point being, $55 to $60 isn't going to make those producers happy, and especially not in deep water, Gulf of America sort of things. So yes, it's a good thing that the government is opening up federal lands, for that possibility for it to be drilled. But at these sort of price points we're at the moment, it's not really practical to be drilling. So just keep that in mind. Again, if we get back up to the $70 range, somewhere like that, especially again for a longer period of time, I need to sort of stress that they're probably not going to get freaked out with sort of 1 week drop down and then bounce back up, or 1 week of a spike and then coming right back down. You need a little more time to convince yourself that something is sort of structurally changed. Again, so if we get back up to $70 level or higher for WTI, that's when you start seeing the investment really moving. It's that in-between range, so call it 60 to 70, where you're keeping up with maintenance, you're keeping things going, you're replacing the decline rates that you might have seen in other wells to try to keep your production level fairly steady. And you're just kind of moving along sideways. So that's kind of maybe how to think of these different price targets as we move through. And again, that's why there's a lot of talk about this in the market right now, or on other places like X and different, LinkedIn or whatever. So that's why I wanted to sort of bring it up in this conversation, just so you guys would know sort of what's going on. In the front spread this week is kind of funny in that you can see April 2nd, we had a bit of a sell-off. This is a daily chart, okay? So April 2nd, we started seeing a sell-off in that front spread. And then it started to come back. We had this really low dip down here. Something that would normally be the big headline for the week seems to be sort of completely forgotten in the, just kind of pushed to the side. there's a leak in Keystone Pipeline and it's currently closed and they don't know when it's going to come back up. Normally that would be like a huge event in the market, but there's so much other news and so much other things going on that's kind of getting, like I said, pushed to the back burner a little bit. At any rate, and we'll talk more about that in a minute, but I wanted to show you this chart that we are seeing a pop in the front spread. It's moving back up again. So this would be the May contract less the June contract. So you're looking at 62 cents difference, where May is worth 60 cents more than June. Looking at the cracks, so this is RBOB versus WTI. Gasoline is weak. RBOB is a gasoline blend stock. So gasoline's looking really weak. And again, this time of year, going into the middle of April, pretty soon we're going to make the transition into May. You would expect these gas cracks to be pretty strong, but just everything going on, they're not. A lot of uncertainty in the market, and that's causing these things to come off a little bit. What's maybe a little bit more surprising is that the diesel crack is holding up a little bit better. So yes, it had a down week based on where it opened. It opened kind of strong and then came down a little bit lower, and we're back to weekly charts again here. But it's had a nice run over the past 4 weeks of trying to bounce back from the big sell-off we had back in March, at least for the May contract. So it's had a nice bounce back. Again, there's a lot of debate going on within the market about what the tariffs mean, overall, just for the economy of the country, right? So the economy runs on diesel fuels in terms of getting goods to where they need to go. So the market's having trying to decide which way these things are go. We did finish slightly lower than last week, but overall you can see there's a bit of an uptrend going on here. And it's been a really active week. So one thing I spoke about a while back, I was sort of complaining that volumes were getting low around the time we were on spring break. At least here in Texas, the volumes really started to die off. So you're looking at, sort of early March, and then it continued really through most of March. We had pretty low volumes. And so what I'm talking about here, what I'm referring to, is the volume for the entire crude futures curve. If you just look at front month, you get all this noise of expiration and people winding down volumes and then probably getting back into second month or some forward contract. So this sort of eliminates all that by just looking at the volume of the entire curve. Again, you can pull that information for yourself right off the CME if you'd like to. But the point is, we've got, really low total volumes all through March, around April 3rd. So it kind of took the market a day to figure out what was going on and how to react. Volumes just really shot up. I would say, just over the longer term, 1 million, 1.2 million contracts, something like that is probably average. So we started March at about normal, and we're currently sort of back to normal sorts of volumes. But we had a ton of volume go through the market, twice what we would call normal, with all these headlines going on and people just trying to figure out what they need to do, how to trade, maybe get into trade and get right back out of a trade, just because the news is changing so quickly. The open interest, or OI, just remember every buy has a sell. So that is sort of a gauge of sort of the net positions that people are holding. And that's always a much more steady number than the volume. So you could have, imagine like a day trader who starts the day flat, maybe trades 50 contracts, buys 50 contracts, sells 50 contracts. So that would be the volume of, 50 contracts on the day. But the open interest would be zero at the end of the day, right? Because he's not holding any positions. He's just a day trader. So this is why the open interest is much more stable, because you have sort of structural traders putting positions on that they're keeping for a long time. Think of like a hedger position or something like that, where they're not so concerned about the everyday volatility in the market. They're more concerned about locking in a price that works for them, versus some other physical thing that they might have going on the other side. And you can see I put on here in green the price, so you can kind of see too what was going on. So as the price dropped, the volume shot up. Open interest came up a little bit, but it was sort of already coming up. And now open interest is coming up even more, which would suggest even as price comes down or bounces back a little bit, people are starting to figure out a strategy. They're starting to implement capital back into the oil markets anyway, in terms of putting on positions and leaving them on there. So now to finally get to the headlines, of course, we're still dealing with the tariff mayhem that we've been talking about. We've got the Chinese U.S., what I'm calling a super tariff. It's a triple-digit tariff. It's kind of ridiculous. We'll see how this plays out. For the rest of the world, it seems that Trump put tariffs on lots of different countries. For everyone except China, basically, there's a 90-day pause, and that's where crude oil at least started to bounce back, and I think equities did as well, off of that headline, to give people time to sort of negotiate their way out or to come to some sort of an agreement. But it doesn't seem like China and the U.S. are budging. It's like a big game of chicken or something for the time being. So we'll continue to get headlines on the Chinese tariffs, and I'll have a slide to show you, at least from an oil perspective, sort of what that means. I mentioned last week OPEC surprised coming up with ramping up their production schedule. So they were going to bring production on. It's been sort of telegraphed to the market for a while now. But what happened last week is they said they would, instead of going to the levels that they said they would for the month of May, in the month of May, they're going to shoot all the way up to the production targets they had for July, which was originally increasing by about 140,000 barrels per month, barrels per day per month, consecutively month on month. So they kind of skipped ahead a little bit. We were scratching our heads. It definitely caused some weakness in the market on top of everything else, on top of the tariffs last week. We still need to watch out by the 15th of April. The overproducers need to come up with some sort of solution. So again, that could be maybe a bullish hit on the market if the overproducers start to bring barrels back off the market as compensation. So please be looking out for that on the 15th of April. But the new news, I guess, this week is that China looks like they're scooping up a lot of Saudi barrels. Again, probably shying away from the U.S. stuff. Don't blame them. And looking for other places like Saudi that are increasing production. They did decrease their OSP, their official selling price. So that all seems to be a match made in heaven right now. China's also looking at Iranian barrels. So again, there's still the Iranian tensions going on between the U.S. and Iran, with Israel in there, maybe spurring things on a little bit. But it looks like China's just trying to get their hands on any barrel that they can that's not from the U.S. at this point in time. So China is basically Iran's only buyer. I mean, yeah, there's a few barrels going here and there, but the bulk of the volume of the Iranian exports end up going to China anyway. And it sounds like the Chinese are trying to find more barrels before any more sanctions might go on Iran. As I mentioned before, there's a Keystone spill in North Dakota. It doesn't seem too massive, but it's shut down the pipeline. They don't have a timeline yet on when they're going to get that restarted. So we'll have to sort of wait and see there. Probably a couple of weeks, but we'll see what happens. And just so you know, on Keystone Pipeline, it flows from Canada to the U.S. It goes into the Midwest. It kind of branches off in Steel City, Nebraska, where one leg of it goes down to Cushing, Oklahoma. The other leg goes to Patoka in Illinois. Historically speaking, so sort of stepping back and looking at long-term averages, about 2/3 of the flow ends up going to Cushing. 1/3 ends up going to Patoka. Again, as you have refinery outages and stuff going on, that might shift from time to time, but that's kind of the rule of thumb. So it is a big deal to Cushing. Again, that's important because Cushing is the delivery location for the WTI contract, and that's going to affect how much volume is at Cushing, right? If you take that major pipeline away. So again, that's a pretty big thing going on in the market, but given all these other headlines, it's getting sort of pushed to the back of the line, which is interesting. So let's get into sort of from an oil perspective, at least, what our trade balance is with China. The table here on the left is just what was going on in Jan 2025, because that's what we have data from the DOE. So just to kind of walk you through this real quick, in terms of barrels per day, 1,000 barrels per day, the U.S. exported to China 855,000 barrels per day, which is a decent amount. That's a good number. We only imported from China 14,000 barrels per day, which frankly is more than I thought we would. It's usually a pretty low number on the import side of things. This chart here on the right kind of bears that out, that we are almost always a net exporter, if you will. So a negative net import is a net export. We did have some spikes in the middle of the year last year, but that's a little bit unusual. Usually the import number is pretty small. And I just listed exports as a negative to give you a better way to sort of visualize what was going on there. At any rate, going back to the numbers from January of this year, 2025, just to kind of to give you a scale of what's going on, at least just in terms of the oil market, the value of these exports was somewhere around, call it $900 million for that over the entire month of January. In terms of our total export load, the exports to China of crude oil was only about 3.4%. The exports of ethane, almost 50%. And that's kind of a big deal. We'll circle back to that in just 1 second. You can think of all these NGLs as being a pretty decent chunk of the total export that's going out of the U.S. On the import side, it's relatively small. They sent us some conventional gasoline. So it's listed as a blend stock the way it comes in. It's only 13,000 barrels per day. U.S. gasoline demand is 8.5 million barrels per day. So relatively small chunk of the overall sort of demand pool, if you will. And in terms of imports, it was only 3.1% of the imports that we received from all countries in the month of January. When you look at biodiesel, again, statistically, it's a big chunk, but we don't really import that much compared to how much we produce. So again, both of these are somewhat negligible in the long run. Again, it's 1,000 barrels per day of biodiesel. So that, again, it's not a big number overall. But let's get back to this, the NGLs, especially the ethane or ethane. That's a pretty big chunk, and it's sort of up in the air right now. There's a bit of a question going on as to whether China can do without these barrels, right? Are they just going to be forced to run U.S. ethane at a way overly inflated price? So you'll notice the price is roughly 11 cents per pound. So it's traded a little bit differently on the NGL side. That's why that's why it looks different than everything else. So that's going to be the big question. Can China continue to operate its steam crackers? And again, this eventually goes on to be plastics is where that ends up, right? So can China continue to go forward without this import from the U.S., even though it's going to triple in cost or double in cost, given the triple-digit tariffs? Is that still going to be cost effective for them? Can they replace those from anywhere else? The Middle East makes a lot of NGLs also, and I'm sure they're trying to pivot. China's trying to pivot as much supply, to talk to the dealers in the Middle East to try to get as much supply from them as possible and replace this stuff that's going to be tariffed going into China. But I think it's going to be tough. So this would be the place to watch. This is going to be the thing to look out for. What's the economic impact in terms of China manufacturing? What's the next best cost that they can get? Assuming it's going to be from Kuwait or Saudi or UAE, something like that. So this is the thing to watch. The crude oil and the pet coke, maybe not as important. You're talking about China where you've got 11 million barrel per day import number, something around there. So this crude import number is basically nothing compared to that. But that should give you just at least some sort of context as to, from an oil perspective, of what the tariffs might mean at this point in time. Obviously, if we're net exporting to China, that trade balance is in our favor, right? Because we export so much more than we import from them. But the way I presented it here as a net import number is showing up as negative. So we're seeing a lot of gasoline weakness, like I alluded to earlier in the price charts. Retail gasoline still went up this week. Again, that retail gasoline number is really a function of what happened to price on Friday, and it just sort of pulls forward into Monday when the DOE does their survey. So it's too early to see in these official numbers from the DOE the drop in retail gasoline prices. Next week we'll absolutely see it in there, and that'll be interesting. I mean, you probably already know this, but pump prices go up much faster than they come down. This is the time when the retail gasoline sector gets to make a little bit of money. When the market's just going straight up, they don't make any money at all on that. They're just kind of living hand to mouth at that point in time. Diesel fuel also increasing a little bit, but again, it's been in a pretty tight range this whole year, so probably nothing too dramatic. If we look at the forward futures curves, you can see how much gasoline has weakened up. So right now, gasoline is trading at about 8 cents under heating oil at the very front of the curve, heating oil being ULSD for all intents and purposes. So it's come down week over week, 6 cents or so from the 2 cents under it was marked the previous week. The week before that, last week of March, they were looking pretty close to flat, at least for that May contract. So gasoline has weakened relative to everything quite a bit here in the past couple of weeks. And then that brings us to our final chart, which again is the pad breakdown. So you can sort of, I use this terminology quite a bit with the pads. I just kind of want to leave this in here for people to be able to translate what I'm actually trying to talk about. So that's all I've got in this week's presentation. Again, like and subscribe. Go to our website, theoilbalance.com, and we'll see you next week.